This panel will discuss how companies are revisiting their finance and tax strategies and looking for ways to optimize operations while being adaptable to China's evolving conditions. Panelists will examine key success factors of investing in China, such as tax incentives, exchange controls, and financing options, and review the opportunities and challenges that come along with these evolving conditions, and help identify challenges and help identify strategies for success and ensure compliance with rules and regulations. The distinguished speakers on this panel are John Quello, partner and head of venture capital investment of Stepstone Global; Wendy Ying, international transfer pricing director of PwC; and Tony Yu, director of tax of PwC. This panel will be moderated by Eugenia Rao. Ms. Rao is a tax partner at PwC, and she has over 18 years of experience in U.S. tax consulting and compliance services for cross-border multinational corporations. She leads the PwC China Business Network and the inbound tax practice in Northern California, and has experience in various industries including real estate, entertainment, retail, and technology. Prior to returning to San Francisco office, Eugenia was the chief of staff for the PwC U.S. tax leader in NY, and she also spent 2 years in Taipei office, where she helped build a U.S. tax practice. Let's welcome our moderator and panelists for the panel.
Thank you, Annie, and thank you everyone for actually attending the tax and finance panel. I didn't, given it's a concurrent panel, and I wasn't sure such a technical topic would be as interesting as some of the other panels. But I shouldn't put our panel. We have great panelists, but I personally sometimes find that people find tax a little bit boring, but I do not agree with it. In any case, I wanted to kind of ask around who has actually done business with China, either companies from China or U.S. company going to China. So we have few. And so then this will be very educational, I suppose, and then we'll probably reach out to some of you that have done business in China to chime in when needed. And also, I wanted to keep this panel very open in terms of if there are any questions, feel free to ask anytime. We will leave some time at the end for questions, but we want to be more of a discussion, a dialogue, instead of us presenting to you. So feel free to chime in anytime. But having said that, I will probably just start asking some questions to get the dialogue start going. And the first question, first I will actually let each of the panelists introduce themselves, and then they also wanted to share some of the perspective. And I want to thank John for joining the PwC panel, being the only non-PwC person. But John, do you want to go ahead and?
Absolutely. Thank you, everyone. It's good to be here. My name's John Quello. I'm a partner at Stepstone Group. We are a private markets advisor. So we invest in private equity, infrastructure, and real estate. And our clients are institutional investors of various stripes: sovereign wealth funds, pension funds, corporates, university endowments, family offices, folks that are investing at scale in private markets. I head up our efforts in venture capital and growth equity, which has predominantly been a U.S. effort, but as we've globalized our firm and as our clients' appetites have grown in interest in emerging markets, we've increasingly been active in venture, buyouts, and growth equity in other markets around the world, and certainly China is probably the first and most important of those markets. We've been active in China almost since the inception of the firm. We were started in 2007, and so in the very early days of the firm, we were advising some of the sovereign wealth funds in China on setting up their private equity programs. We had staff seconded to these groups, but maybe more importantly, we have had a presence in China, for over 5 years now. Our founder and CEO, Monty Brehm, actually moved to Beijing to set up our office. And we have since built, a very sizable team in Asia, which is really largely local Mandarin speakers. So that's a big theme of ours, is we like to have, people with local knowledge on the ground in these various markets we're investing in. So in addition to China, we have, an office in London where we cover Europe and Africa. We have an office in Sao Paulo where we cover Latin America. But within Asia, our presence is really Beijing. We have some folks in Hong Kong, and last year we opened Seoul, Korea, and we have a team in Australia. And what we do is we build customized portfolios of private equity infrastructure and real estate, which means we invest in new funds that are being raised. We're very active buyers of funds on the secondary market. So that's an asset class that has grown in prominence, the secondary investment area. And then we're actually increasingly active direct investors in companies, either co-investors or potentially co-lead investors in buyouts, venture, and growth. And China's a very important market for us. It's, we've really anchored our Asia team there. I actually was in China last month. I had an opportunity I was part of a broader Asia trip. But there's, the reason for that trip is actually because we are expecting to expand our activities in China, especially on the venture capital side, which we can talk about over the course of this panel.
Thanks, John. And Wendy and I work a lot together, but I will let her introduce herself as well.
Great. Well, thank you very much for joining this panel. And I'm very honored to be part of this conference this time and also part of this panel. So I'm a transfer pricing director at PwC. As Eugenia mentioned, that I work with her a lot just because, when we try to help the clients to plan the transaction, and there's a lot of different areas that we need to look at together. Now, I specialize in the transfer pricing area, and I do want to understand from the audience side to see whether anybody had heard the term transfer pricing. Because okay, great. We have another person in the back. So I guess, based on the numbers, I think that I might try to give you a very quick overview of what transfer pricing, what we do. So I'm trying to make it, very, very simple to understand. So what we do is we try to help company to look at their cross-border transaction. Or sometimes we look at a lot of international operation. As we are aware that a lot of companies, they're not going to, operate domestic only, right? So they go abroad, and we have a lot of activities moving into China in recent years as well. So we do look at transaction in different parts of the world, but giving, so we are focusing in this section, we're focusing on the transaction between U.S. and China. Now, just think about that, when you have a company in the U.S. and you try to expand your market, and you want to go to China, and you may want to set up a company. And so when you have a company in China to sell the products domestically, and then you might have a company here to say, hey, I'm going to provide a product to China to sell it locally. Now that's create a transfer pricing issue, because our analysis is to try to help the clients to look at the transaction between the U.S. company and the China company, and how to price those products properly, or on an arm's length basis. And transfer pricing is it's analyzed on an arm's length basis. So what it is when you conduct a transaction with a related company, a lot of time, just like you work with your own family, right? If I give you a loan from a family, I don't have to charge an interest rate. But if I work, so similarly, if you work with a related company, you can say, well, I don't want to charge your interest rate, but that's not what the market really works, right? So the tax authority in different part of the world, they don't like that. So they said, well, you're operating in China, or you are operating in U.S., Now, I want you to pay your share of income in each country. So that's why they monitor those transactions between countries to make sure that you have the arm's length arrangement. So that's what we come in to say, well, we're going to provide some analysis to make sure that you have a pricing strategy in place to comply with each government. Because no government want to take less money, right? So that's, sometimes we see a lot of challenge in those areas. So product is one of the type of transaction we look at. Some other type of transaction, it could be a service you're providing for your related company, and so those are different type of transaction we look at. But we can talk a little bit more about that later on. But just to give you a little bit background about the U.S. transfer pricing regulations, right? And U.S. is one of the very early country to set up the transfer pricing regulation back in 1968, but we have not seen a big enforcement in this area until probably like 10 or 12 years ago. But then, a lot of countries in the world, and like in Europe, they are also very good in the transfer pricing area. So the tax authority, they all set up the transfer pricing regulation. Now for China, when we look at China this time, then China actually picking up very quickly too. So starting in 1998, China started thinking about transfer pricing. They seeing everybody doing transfer pricing. Every country is have a transfer pricing regulation. So China said, I'm going to set up my transfer pricing regulations. So in 2000, I think the early stage in 2000, so I was invited to China in Shenzhen. And so the tax bureau invited us to go to do a presentation, a training over there. So that's the time they start thinking about transfer pricing. Now in 2008, they start implementing a detailed rules how to comply with the transfer pricing regulation in China. So that's why one of the reasons we want to cover this area, just because if you're thinking about making investment in China or any part of the world, there's going to be, transfer pricing, a lot of transfer pricing issue that we need to, try to look at and try to consider how we put together some of the strategy in place.
Thanks, Wendy, for the education on what transfer pricing is. It really is a pitfall itself. A lot of companies that are doing cross-border business with related party, because if you have a headquarter and you have a subsidiary, you're by default related party. And companies don't think about, because you're doing transaction within related party, that you have to consider transfer pricing until they're audited and then assess penalty. So it's always good to think about transfer pricing as one of the items when you're doing cross-border planning. You may notice that Tony's actually not on the pamphlet, and that's because I tricked him into being our panel just a couple hours ago. So, and then I'll let Tony introduce himself.
So I'll just do an impromptu, I guess. Hi, everyone. Thank you for joining us. My name is Tony Wu. I am the International Tax Director here at PricewaterhouseCoopers. My work, I work very closely with Wendy and Eugenia. I'm a tax specialist, so what we do is, in the international tax area, my clients are mostly US-based clients investing overseas. We call it, in our sense, we call it outbound investment into foreign jurisdictions. But recently we've seen another tide of investment into the US by Chinese companies. So anytime we have capitals move cross-border, then there are numerous tax issues we have to consider, because the US taxing authority is very unforgiving. The IRS has been, very aggressive in terms of keeping these cross-border investments under their surveillance, and because and there's a huge risk of if you get tripped up, right? So there's huge risk of your investors getting so their investment value would suffer, right? Imagine if IRS knocks on your door and say, okay, you have invested in a foreign country that you think is a tax-free transaction, but it's actually a huge tax bill that you are not paying, plus interest and penalty. Then you have to incur, a lot of unexpected tax bills. So that's a risk to the shareholders on their investment. So So tax is very important. I guess in our panel we'll talk more about in the later point.
I mean, right, tax is very important. As a tax partner, a lot of companies, tax is an afterthought that I worked with, but in reality, companies spend a lot of time trying to cut margin here and there, but anything you do doesn't exceed a couple percentages. But tax itself, as people know, US now officially has the highest tax rate in the world. And companies have to pay up to 35%, and that's just federal. Not to mention for states, typically it could be up to 40%. So if you do it right, potentially, and hire us, PwC, can lower that tax rate. In any case, so do you guys hear us better now? Or okay. So the first question I have for John is, for the US companies that are investing in China, what are some of the financing options available, and what are the advantages and disadvantages for these options?
So we really think about it in sort of two buckets. I mean, we have local clients that are Chinese institutions, like Chinese insurance companies that are investing in domestic opportunities in China. They could be funds or companies, and that's really a specialized R&B practice that we have, where that's an investment opportunity that's only available to those entities. So our U.S. or European clients cannot participate. Well, there's some exceptions to that, but as a general rule, most of that activity is on behalf of our domestic Chinese clients, these R&B funds that are really Chinese structures, investing in Chinese entities, and it's really a perfected path for liquidity on the Chinese exchanges, Shanghai. That is a small subset of what we're doing in China. Most of what we're doing in China is investing in Cayman structures, U.S. dollar-denominated funds that are setting up and then as a strategy, they're investing in China. That is, it's more of a global investor. That's a foreign offshore investor. These are the big U.S. and European and Australian entities that are looking to get exposure to, this massive high growth market that is China. The challenges or that path, I guess, to financing has benefits in that it's easier to list on Hong Kong or the U.S. exchanges. There's kind of a more clear path to that type of liquidity, and so those are sort of the two buckets, I guess, as how we think about it in terms of our China investment practice. One of the structures that's been used is this VIE structure, variable interest entity, and this is something that there actually has been a new set of rules that are being proposed by the Chinese regulatory authority that might change the way that this process works to actually bring more control to the China management team. But this has been a very common path to structure an investment for if you're an offshore investor to get exposure to an onshore asset. It's through the SPV structure that's known as VIE. A lot of the well-known kind of mega cap Chinese internet companies, Baidu, Alibaba, Tencent, they all employ these structures. And so this is an important thing for investors to understand. It's an evolving regulatory area, and so that presents risks and opportunities. And it's I think that's a recurring theme that we'll talk about as we go through the topics on this panel of just sort of there's an evolving nature to a lot of the sectors in China, financial services, for example, where they're just really structuring the rules to figure out how to accommodate some of these new business models. So, everyone's heard of Lending Club, a venture-backed, high-flying public company now, peer-to-peer lending model, well known in the U.S. There's a version of Lending Club in China called CreditEase, which actually has more revenue, a bigger book of loans, and so it should be a bigger company when it eventually gets public. But because there's uncertainty around the regulatory environment, it's still private, and it won't be able to get Lending Club's valuation until we have clarity around that regulatory path.
Thanks, John. And then, Wendy, what are some of the U.S. tax companies' ways that they're doing to optimize their functions in order to achieve better operation and financial flexibility?
Well, I think that, there's so many things to consider in China. If you try to set up a company in China, right? I mean, we are in a different countries, but I think that I sort of point out 4 key elements that I think that is very important. Now, we touched upon a little bit about transfer pricing earlier, and some of the transaction can be going to China. It could be you selling products from U.S. to your China company, and then you could provide some type of support service to your China company, or you can provide a loan, or you can provide a know-how. Those are very common transactions we've seen. So typically, when I look at a company, I say, well, first, let me know what your operation is going to be in China. Then we can help you to set up the type of company that fit your business goal and your tax goal. Now, so China in general, they have done, you can do a joint venture. Some company might say, well, I don't want to set up an entire company because so much rules, so much registration requirements. Maybe I can start with a joint venture. So you find, a third party there to try to do a joint venture. It might be a little bit easy to start up, but of course you lose a little bit control of what you want to do. But then the second thing that they offer is a foreign investment enterprise, they call. So the foreign investment enterprise come in different form, and so they, a lot. One of them you can own 100% fully owned. So they call it a wholly foreign owned enterprise, and that's pretty popular too. And then now, if you are, so let's take an example, and you are thinking about selling products to China through a company, so you could set up a wholly foreign owned enterprise that you wholly own this company, or you can set up a rep office. Now, this is something that we don't hear a lot in the U.S., a rep office. But China has been evolving because a rep office, if you set up a rep office, the requirements are very different because they don't want you to have a lot of activities or function or responsibilities. So compared to a full function entity, so depending on how much you do, so transfer pricing come in place to analyze your activities in China. So we will, try to work with a tax group, Eugenia or Tony, and try to to identify the right type of company for you to set up. And I think that's one of the criteria is that what type of company. Like for example, even the rep office, China has continued to change the rules on rep office because they say, well, this provides the lowest tax, structure for a lot of taxpayers in China. So they start changing the rule how to calculate the compensation. So one of the things that they call the deemed profit rate. This is nothing that we heard of in the U.S., right? Deemed profit rate in China. So a rep office, they want more than 10% return. So with limited functions, just one example, right? So you can see the rules in China are very different. How to set up a company, what other consideration that you need to take into. So I think that the type of company depends on the type of operation that you have. And the second part that I think that we also have to be aware of what type of tax that we are subject to in China, right? A lot of us, when we set up a company, the first thing we say, corporate income tax. That's the first tax would come in mind. But there's a lot of other tax that we need to keep in mind, like some indirect tax that we also have to think about. We have value-added tax in China, which is not in the U.S., but it's popular in Europe. Some of you might be familiar with. And then we have custom duty, withholding tax on passive income that Tony can also speak a little bit more for that if you like. Now, one tax that we don't hear about in most countries is called business tax in China. And so that's something that you have to think about if I operate certain type of product. So business tax usually a tax, the service company is subject to business tax. So those type of taxes is, additional tax you have to take into consideration. So you can say, well, do I want to set it up there, or how should I, identify the best way to operate in China? So that's a third component, right? So now, I think John is trying to, help his investor to make money in China. Now, our clients, a lot of time we hear from them is say, how do I bring the money back, or, send the money back to the U.S. or some other places, right? So this is one of the consideration you want to think ahead of time. How do you get the cash flow out of China? So Tony can speak a little bit about that if you like.
Right, essentially, yeah, definitely. So for U.S. companies or funds that invest into China, usually it's any places.
The microphone might be helpful. Oh, it's not working. I came in late. I'm sorry.
So
we were trying to speak a little bit louder.
we'll talk higher. So the goal is eventually for those foreign investments to sort of repatriate the earnings back to the U.S. But foreign countries, including the U.S., most of the countries have what we call withholding tax on the outbound payment of earnings. It could be in the form of dividends. If the U.S. company is investing in China and China makes a dividend distribution, there are a few hurdles that the dividends has to, the Chinese company has to go through in order to remit that dividends back to the U.S. First of all, they have to go through a rigorous application process because China has a strict foreign exchange control. So anytime the money is cross-border money going out of China, there has to be a process, and then there's certification process. Application needs to be in place. So it's not as easy as you just wire the fund out of China to a bank account somewhere else. It's against the rule, and you cannot do that. So that's legal restriction. You're gonna have to get that lined up, and also there's tax risk or tax procedures there you have to go through. There's withholding tax procedures. And then China was gonna withhold on those dividends coming back to the U.S. And how does the U.S. Take the credits on its U.S. corporation or investment vehicles tax return? Because whatever tax is paid in China, it's going to reduce U.S. companies' tax bill in the U.S. because otherwise, the U.S. company via its investment or in a sense, it's paying 2 levels of tax. Sometimes it could be 3 levels tax, depending on what is a form of the U.S. entity. U.S. corporations is taxed 2 levels of tax. Corporation itself get taxed when the corporation distribute the money out to its ultimate shareholders, wherever, if they are the U.S. shareholders, most of the time, the shareholders get taxed again. But what if the investment in China get taxed? Then that's 3 levels of tax. So whenever there's investments into a foreign country, then including China, the best way is to think about the tax consequences ahead of time, not after the fact, because once we know and we model out how much tax outlay is going to be expected by that potential investment, then we can sort of plan things a lot better, as opposed to after the fact. Then it's not as efficient.
Yeah, we get a lot of feedback about cash flow coming out from China. So.
Yeah, and basically what Tony touched upon in terms of multiple layers of tax, you're certainly looking at, there are opportunities, country using treaties, and but it's very complex. There's a lot of, just because 2 countries are doing business doesn't necessarily mean you can use the treaty. So there's a lot of complication there. And Tony, you actually started answering my next question. I don't know if you have anything else to add, which is how are companies structured and organized, and what are the processes that they have in place to better themselves with global operations? I know you already covered that, but if you have anything else to add.
Yeah, usually from a common common holding structure of U.S. company investing overseas, especially China, is usually we'll see an intermediary company set up somewhere. The popular jurisdictions are Hong Kong, Singapore. Basically, the jurisdictions have favorable relationships with China and the U.S., for instance. So Hong Kong has been historically a very favorable jurisdiction. We would normally not see, if multinational companies in the U.S., we don't normally see them investing in China directly. The reasons being both tax and regulatory and legal protection liability reasons. Because China, the U.S. multinational companies investing in China, they want the legal protection. So imagine if you have U.S. company invest directly in mainland China, then it pulls in your U.S. corporations directly into the China taxing legal system. But if you have a middle layers, for instance, Hong Kong, in that sense, then Hong Kong would be pulled into the legal mess, if you will, instead of the U.S. So you have that added layer of protection. And two is that it's a lot easier to move money in Hong Kong than in China. Well, China is increasingly doing better in terms of loosening control on the foreign currency, but it's not as established or as well known in Hong Kong, because it's been a while, and the lawyers in Hong Kong get used to work with other jurisdictions in the world. So it's a common holding company structure. So in that sense, we could see the structure being efficient because, and also the cultural similarity to, because it's in the same sort of culture circle, Hong Kong and China. So it was normally it's a common holding structure, and when the funds is repatriated back from China to Hong Kong, and then from Hong Kong eventually back to perhaps going through another intermediary to tap into the treaty, but that's so when we structure into China, we think about those layers of structures and to figure out the best effective way, tax efficient way to structure the investment.
Thanks, Tony. So given that we have 10 minutes left, and I wanted to turn over to the audience, yes? I think you raised your hand first.
Suppose you have a wholly foreign-owned entity that you're forming in China, and you have an American company that is licensing intellectual property for their use.
That's right.
Now, two questions related to that. Number one, what are the special considerations that you have to deal with here? For example, is the payment of that licensing fee subject to withholding tax? And secondly, what is the advantage then of having a Hong Kong-based intermediate company that actually owns the wholly owned foreign entity in China?
Tony, you want to take it first, and I'll touch on the transfer pricing.
Yeah, obviously, definitely.
Is this question too technical for people? It's all, okay.
Okay, because you brought a very good question, because intangible is one of the key areas that they attacking in every part of the world. So
Yeah, the reason, and also why intangible is easier to attract attention is because like as you mentioned correctly, it's a royalty. A royalty is fungible. It's like, it's you can basically determine the value of your intangible and call it your royalty, say 10 million, 1 million. But then where it's the transfer pricing comes into play, what's the the right amount of royalty paying out of China? China's going to withhold on their royalty because it's just if the intangible is used in China and it's producing economic benefit within the Chinese jurisdiction, that outbound royalty to its IP owner, for instance, here in the U.S., China's going to withhold on it.
right.
And by going through Hong Kong, Hong Kong is historically has been a more favorable IP holding jurisdiction because Hong Kong has a favorable jurisdiction where, first of all, Hong Kong doesn't have withholding tax for dividends and interest. It has a very favorable royalty withholding regime, meaning if Hong Kong pays a royalty back to an unrelated party, the effective tax rate is only 4.95%. But we have to structure it very, very carefully, because if it's paid to a related party, effective tax rate in Hong Kong is 30%. So there's a huge difference there.
So I think that Tony touched on, if you have a, IP and you have royalty arrangement, that you pay a royalty, that's subject to withholding tax, which is kind of like for passive income. So it could range from, 0 to 30%, depends on how you structure it. So if you have a jurisdiction where U.S. does not have a tax treaty, you will be subject to the highest at 30%. So that's a lot of money, when you think about 30%. So from the transfer pricing's perspective, we have different strategy for intangible, dealing with intangible, pricing the intangibles. There are something that probably I would say that is not, a lot of people are not familiar with, called cost sharing. Like we have two related parties sharing the cost and the risk of developing the future intangible, but we're looking at the economics ownership, not the legal ownership. But now, currently, I would say that it's very interesting. It's actually a very interesting topic, because in the U.S. we have a good list of what cover intangible. And one of the very new topic that we have been touched on in the past years is called the BEPS. Anybody heard of BEPS? Base erosion, profit shifting. So BEPS is an action plans put together by OECD organization. So they almost like a UN, their role, but they're looking at the economic of the whole world. So the government have a big, really big meeting in Paris a few years ago, involving a lot of countries, and they are, part of the OECD members. China also joined the big meeting to understand how they're going to look at IP. So now we have a totally new definition of IP. So the list is just the opposite of what we see, and they said if it's non-financial assets, it's not John's area, it's not a physical asset, anything can be considered IP. So that, we are looking at different way of analyzing it right now. But part of the strategy, if we put the IPs, I think some of the consideration with dealing with China is China will attack that you're going to be, because IP is a value driver in the transfer pricing world when we look at the economics of the transactions. And they will claim whenever you own an IP, the general, principle is you will need to make a lot of money. So whenever so we will try to help the company to identify our IP strategies. They say, should we have the IP in China? Should we have the IP somewhere else? How do we centralize them? And because the IP does go along with, the profit. So to your question, I think that the strategy here is that we have company, I think that we run into some IP issue. So one of my clients actually, that is the actual case, so the U.S. actually providing the IP. Now, we have the same basic principle for transfer pricing, but the challenge that we run into in China is the interpretation could be the opposite of what we see. So the IP that we said, well, the U.S. giving you an IP. And so China said, I'm not going to recognize it. I'm not going to pay for it. This belongs to me now. So you need to report more tax. So those are challenges that we see from case to case. So just kind of, so that's why, I think that a lot of time, one of the area that we can help is we do negotiate, we call the advanced pricing agreement. So this is a process in which that two governments sit together, U.S. and China, because they have a tax treaty. So the tax authority on both sides can sit together, and we will help to develop a model or a method to go into negotiate this IP arrangement. So that's one of the way that some companies deal with right now.
So the advanced pricing agreement that Wendy mentioned, it's short for APA. There's two types. There's unilateral, which is only one country agreed to your agreement, or bilateral, which is both countries. So if the transaction is really significant, you want to get bilateral, where both countries agree on the pricing ahead of time. And I know you had a question earlier.
Actually, my question is for John. So, hi. So I know you and your firm have a really strong specialization in infrastructure investment in China. So I believe you have already heard the newly proposed strategy by Chinese government, the PPP, public-private partnership. So do you have any comments on that? And would you or your firm be interested in such program?
Yeah. So we have a separate infrastructure team that's really lives and breathes that area. I'm really more focused on technology and growth, but I do work with some clients where I manage an infrastructure portfolio on their behalf, where I'm leveraging our sector team to find good investments for us. And it is certainly the case that we think that among the more interesting infrastructure opportunities are emerging markets like China, India, and Brazil, where there's a critical need to fill infrastructure gaps, whether it's energy pipelines, it's water infrastructure, social infrastructure is part of it, traditional ports and toll roads, et cetera. So the PPP model is, it's a proven model kind of in the developed markets, and we're starting to see that really blossom in emerging markets like China. I think one of the challenges with infrastructure investing is that it's, you need to have scale, and so many of the most credible infrastructure investors are actually, building teams and doing this themselves. So it's like sort of the big investors in Australia and Canada have really pioneered this. But I think infrastructure investors globally there's just different categories, right? There's sort of the greenfield, and all the way to sort of brownfield, more, developed types of opportunities. And they have a spectrum of risk reward. I think for the infrastructure capital that's looking at China and other markets, probably focused on a higher return, frankly, just given that there are a lot of opportunities to deploy infrastructure capital in developed markets like Europe and US. And so what we're trying to do is look for those investment opportunities, be they projects or funds or joint ventures in China, where we're very concerned with the counterparties that we're working with. We're very concerned with the regulatory environment, and we would typically be looking for a higher level of return on a Chinese infrastructure opportunity than we might, in something in the U.S. But typically, like, our infrastructure activities have been more focused on kind of the higher returning part of infrastructure, because so many of our clients, they can invest in lots of things around the world: venture, buyouts, infrastructure, and so a dollar deployed in infrastructure, might compete with another opportunity they have. So, but to specifically answer your question, yes, the PPP model is something that we're starting to see more activity around, and China infrastructure is a big theme of ours. We think that across different sectors, there's a lot of opportunity. And in fact, we've just in this past summer purchased a portfolio on the secondary market that was a portfolio of projects in Chinese infrastructure. There was some renewable energy, there was a port, there was a road system, and so that was, it's a good example of where our team in Asia, our direct investment team, and our infrastructure team collaborated to move on this really interesting deal and execute it in a short time frame.
I know our time is up. It's up to you if you want to stay, because there is 15 minutes break. Do people want to stay? No. Okay. If people want to, maybe we'll give some time for those who want to leave, and then those who still have questions, then
we're
here to answer questions.